On August 15, 1971, President Richard Nixon appeared on television to deliver a sudden announcement. The United States would no longer exchange its paper dollars for gold. The government had, for all practical purposes, defaulted on its monetary obligations. This chart tracks the Dow Jones around the announcement. The expected Wall Street reaction was total carnage, a steep downward projection. Instead, the stock market shot up nearly 4% in a single day. The dollar tumbled, yet equity soared. For a young clerk on the trading floor named Ray Dalio, this defied all conventional logic. It forced a realization. Investors and policymakers make catastrophic errors when they are blindsided by massive economic shifts that have never happened in their own lifetimes, yet have played out repeatedly in historical data. This chart illustrates Dalio's big cycle. By trading macroeconomic history as a mechanical engine spanning 500 years, a pattern emerges. Every major empire operates on a predictable lifespan, characterized by three distinct phases: a birth, a prime, and a decline. To understand our current era of extreme sovereign debt and intense political polarity, we have to look past the daily news cycle. We must examine the actual, deterministic machinery that governs how every great global power rises to hegemony and eventually collapses. A typical imperial cycle runs for roughly 250 years. The cycle always initiates after a major global conflict or revolution. The victorious power establishes a new world order, writes the new rules of international engagement, and launches a prolonged era of peace and economic expansion. The 8 determinants of power begin with education, fueling technological innovation. This boosts competitiveness, expanding economic output and world trade. A formidable military protects these routes. Wealth builds dominant financial centers. And finally, the currency becomes the world's reserve currency at the empire's absolute peak. The money cycle follows a sequence. It starts with hard money, like gold. To expand, it evolves into paper claims, fueling credit creation. When debts balloon, governments default and transition to fiat money, printing currency that devalues completely, driving the economy into systemic breakdown. The ability to borrow excessively because everyone else holds your currency is an exorbitant privilege. Yet relying on the printing press to finance overconsumption and military overextension rots the nation's finances from the inside, mechanically planting the seeds of its own eventual collapse. Applying this model to the historical data yields a consistent pattern. In the early 1600s, the Dutch Empire rapidly ascended this curve. Despite their small size, rigorous education and extreme inventiveness allowed them to dominate global shipping and trade. They invented modern capitalism, creating the first publicly traded company, the Dutch East India Company, and established the guilder as the world's first true global reserve currency. But by the 1700s, Dutch wages grew expensive, rendering them less competitive. They entered costly wars to protect their trade routes. To cover mounting debts, the Bank of Amsterdam printed fiat money to bail out corporations, destroying the guilder's value and ending their hegemony. As the Dutch fell, the British Empire rose to replace them. Fueled by the scientific and industrial revolutions, Britain built an unstoppable navy, established London as the global financial capital, and made the pound sterling the cornerstone of international commerce. Decades later, the cycle repeated. The British grew complacent, allowing rising powers like Germany and the United States to outpace them. Their competitive edge evaporated as they overextended themselves militarily. While Britain technically won the 2 world wars, the sheer cost left the empire functionally bankrupt. Drowning in debt, they continually devalued the pound against the dollar, suffering a long, agonizing economic contraction until their reserve currency status dissolved entirely. Neither the Dutch nor the British empires were conquered by direct military destruction of their homelands. They fell because domestic financial rot and the systemic debasement of their currencies hollowed out their structural power. The United States ascended for the exact same reasons: strong education, technological dominance, and high industrial output. Following World War II, the Bretton Woods Agreement cemented the new American world order, making the dollar the gold-backed centerpiece of the global monetary system. At its zenith, the U.S. produced fully half of all global goods and physically held 2/3 of the entire world's gold supply in its vaults. This chart tracks the American timeline along the big cycle. From a peak in the 1950s, the trajectory descends to the 1971 Nixon shock. the moment the U.S. severed the dollar from gold and transitioned entirely to a fiat system. Today, the data indicates the U.S. has entered stage 5 of the cycle. To manage recurring economic stress, the central bank has printed record-breaking volumes of currency to monetize an exploding national debt, directly driving asset inflation and eroding purchasing power. This currency devaluation acts as a hidden tax, punishing savers while inflating the assets of the wealthy. The resulting wealth gaps have ignited severe political polarization, creating domestic fracturing reminiscent of the economic depressions of the 1930s. Furthermore, as competitiveness declined, the United States became the world's largest debtor, financing its continued consumption by borrowing heavily from a much poorer but rapidly saving rising rival. The crushing debt, the aggressive money printing, and the bitter internal divisions we see today are not random political failures. They are the exact textbook statistical outputs of a late-stage empire operating at the end of its long-term debt cycle. This chart illustrates the current global hazard, a rising rival power directly intersecting with a dominant, indebted power in decline. After a century of decline and exploitation, the 1949 Communist Revolution led Mao Zedong to establish strict internal control and a unified state structure. In 1978, Deng Xiaoping launched pragmatic reform and opening up policies, merging market mechanics with state planning to rapidly accumulate wealth and technical expertise. Under Xi Jinping, China has rigorously executed the classic rising power playbook. Through massive infrastructure investment and top-down initiatives targeting common prosperity, the nation has evolved from a manufacturing hub into a primary creditor and technological heavyweight. This collision inevitably triggers conflict across 5 fronts. It begins with a trade war over tariffs, which quickly escalates into a technology war. The decisive battle for future hegemony is currently being fought over advanced semiconductors, as the winner in computing will likely win all subsequent technological races. This bleeds into a geopolitical war for influence over proxy territories, alongside a capital war. By weaponizing the dominance of the US dollar through severe financial sanctions, the declining power inadvertently forces the rising power to build alternative financial systems. The final phase is a military war. These conflicts rarely start from grand designs. They ignite through tit-for-tat escalation, where both sides are trapped by domestic politics, and retreating feels like a humiliating defeat. Headlines about tariffs, tech bans, and territorial disputes are not isolated diplomatic incidents. They are the mechanistic outputs of the big cycle machinery grinding a dominant and rising power together. The historical cycles of debt and hegemony remain robust, but the application of modern technology introduces a fatal wildcard to this centuries-old pattern. In previous conflicts, damage was geographically contained. Today, AI and cyber warfare operate nonlinearly, capable of paralyzing national grids instantly. Because AI trains on past data, during unprecedented transitions between world orders, these systems can fail catastrophically, accelerating conflict beyond human control. Consequently, leaders must move past short-term tactical maneuvering. Survival requires establishing rigid red lines to contain the mechanical pressures, pushing them toward kinetic war. Yet data reveals that a nation's fate is rarely sealed by the strength of external enemies. The most critical battleground is the internal war. Maintaining rigorous financial discipline, investing in education, and fostering a society capable of civic cooperation are the only true defenses. Without internal health, no amount of military hardware or technological superiority can save a nation from the gravity of the big cycle.